Welcome, everybody. This is the first quarter 2013 webinar for All-Star Financial. An impressive show of resilience is our title this quarter, and I think as we go you will understand what we're talking about there. We'd like to invite, in Bob's Corner, we always have a topic of conversation. We'd like to invite two new players to our All-Star Financial team. Andy Peters is an account executive, University of Minnesota grad in 06, 4 years at Thrivent, and majoring, prior to coming here, majored in business and communications degree, and also was a pitcher for the Gophers for 4 years, and his senior year was the team MVP. We also welcome Tricia Downing, an executive assistant for myself, and office manager, and Minnesota State grad in 2003. She's been in the child care industry for the last 8 years and majored with family life and child development degree. And we want to welcome Tricia as our president of First Impressions. So looking kind of going forward, market overview, 2013 really began with more uncertainty. We have the budget deficit, and the federal budget really had none, and we're just going to be issued one right now. Tax structure for most people were up, but still a question mark. Sequestered budget cuts were basically being forced right now. What will they look like in the end? Europe has another surprise with the Cyprus Bank bailout, and actually some new leadership in Japan, which uncertainty, but it looks like it's going to be a positive business relationship. Other uncertainties would be the Fed and the monetary policy. Right now, they're still pouring in $85 billion in bond purchases each month in what we call kind of funny money. Interest rates, I think, will stay low as a result of that. However, they've spiked up over 2% several times during the quarter, which again is contrary to what it should be with all that money coming into the market. So the bond market is kind of realizing it's a false impression and looking at inflation a little bit more. And then world banks around the world are doing very, very similar bond buying programs to basically get liquidity to the Main Street. One of the things that we're really happy about and creates less uncertainty obviously right now is $100 billion into equity funds and ETFs in the first 2 months of 2013. A big reason why the domestic stock market was up. When we look at the U.S. economy, we look at it recovering, but really slow. We had fourth quarter GDP really nominal at 0.4%. Most of that reduction came because of reduced government spending in the fourth quarter. We do have a housing recovery taking hold, however. Existing sales were up 9% year over year, new construction up 12%, as well as nationwide prices up about 11%. We had a few things on the job market improve. We had numbers go consistently above 170 for the last 6 months. However, we need about 200,000 on a monthly basis. That's brought unemployment down from a high of 10% to about 7.6 by government's current standard of measuring unemployment. And then consumer spending and business spending. Consumers are up 3.2%, which I think again bodes well. However, the income really is not keeping pace with the spending. So people are taking a little bit more on the credit card standpoint in the last quarter at least. Industrial production is up to 79% capacity utilization, which is great. Business confidence has increased. We want to make sure that now turns into spending, and that's really going to be the question. As we've talked about with QE1 and QE2 and now QE3 or Infinity, we need businesses to kind of carry that baton so that we don't have to keep pouring in that $85 billion. So looking forward, slow and steady as we go, I think, again, Fed is helping with that $85 billion a month. Budget decisions would really help and, give some stability to people's thought processes, help businesses spend at a comfortable rate. Although business spending did go up in the fourth quarter, the big question is, will it continue? Going forward with the bond market, I want to talk a little bit about domestic bonds this quarter. As you know, bonds have had really a 30-year secular decline of interest rates. Bonds have had their heyday during that time period with over 900% total return over those 30 years. much more significant total return than the stock market. But we're kind of at the end of our rope. We have high yields. The credit-related bonds are still doing pretty well at a positive 2.9%. Short-term government bonds were basically flat. Municipal bonds slightly positive. Mortgage-backed bonds a little negative. Long-term government bonds lost about 2.3%. And the Barclay aggregate was slightly negative at 0.1%. Global bonds, we saw a negative 2.1 and a negative 2.3 depending on the broad market versus the emerging markets. So again, some real questions as far as how much stability we have going forward in the bond market and what it's going to look like, because it is going to change. And I think that ride is over. We see yield spreads are near or below long-term averages, which doesn't bode well for bonds going forward. 10-year, again, as I mentioned, spiked up over 2% multiple times in the first quarter. Again, showing that inflation pressure with that $85 billion of money going into the economy every month. And that bond market pushing rates higher. Again, they've basically committed to keeping them low through 2015. So even though the bond market wants to see it go up, interest rates go up, and should be going up, the Fed obviously is keeping it artificially low. So we'll see how that battle works out in the long run. One of the things that we want to look at and kind of prepare you, this is the second quarter in a row we've talked about floating rate loans, inflation-protected securities, and other non-traditional loans and bonds that will come into use as the interest rates start to go up. On the domestic stock market side, U.S. stocks were phenomenal. They shined. We had Russell 3000, the broad market index, up 11.1% on a strong dollar, better earnings, better economic info. Dow Jones and the S&P 500 surpassed their 2007 record highs. Large caps were up 11, small caps 12.39. Value outperformed growth, 12.3 to 9.8. And the sectors that were up, financials, consumers, discretionary did very well, technology and materials, a couple of them that did very well last quarter underperformed, although they were still positive for the quarter at 5.5 and 5.1. Looking forward for the domestic stock market, we look at corporate earnings have slowed. Really, you can't get much skinnier than what they are right now. Businesses have cut to the bone. Really, what they have to do is raise top-line revenue. Improved employment and housing could buoy that consumer spending that gives us top-line revenue growth for companies. We think in this type of atmosphere, cyclicals will do well. The tech and the materials that didn't do well last quarter, we think will probably do pretty well going forward this quarter. And again, one of the big things that people have to realize is that companies are really cash-rich right now. They have a lot of reserves because of the uncertainty. They haven't grown now for maybe 2 or 3 years organically. They've basically grown bottom line profits through getting skinnier. And so really, how do they grow? And they grow through acquisitions. So we think merger and acquisitions will be increasingly more popular here this quarter, as will the dividend payouts increasing in the value side of the world, but also in the growth side of the world too. Where growth stocks, I think, are going to pay dividends more and more as we go to create that ownership and stability with shareholder loyalty. Foreign stocks, if we look at what's gone on there, all areas really underperformed the U.S. stock market this last quarter. The U.S. dollar's appreciation didn't help, obviously. Continued economic woes in Europe and that region. And again, then the focus on U.S. stocks, where money was going into U.S. stocks, not worrying about any currencies, and the foreign stock market kind of got lost in the shuffle. Performance of Europe was up about 2.7%. The EAFE index, which is Europe, Asia, and Far East, up about 5.1. S&P Global BMI of about 7.0. This is the one we feel like we are most representative because it's global, not just domestic or international, but it's global, as it says, broad market index. Emerging markets down 1.6%. China took that to a little bit more of an extreme, down 4.5 after a great 12.4% rate of return in the fourth quarter of 2012. And Japan surprised everybody with its new prime minister and his pro-growth economic policies increasing 11.6%. So again, something that was a little bit more than anybody would have predicted at the beginning of the quarter. Foreign stocks looking forward, we still think they're just a great buy. We've got 5% GDP growth forecasting in the emerging sides of the world, which is higher than the U.S., 7.5% specifically in China, obviously higher. And both areas are really significant discount to long-term valuations. So we look at emerging markets and specifically China being very, very good going forward. But it does have risk. It does have struggles that they have with currency as well as being affected by Europe. Europe still struggles with although the high dividend stream that they're paying is very attractive. Japan, again, with promissory reforms, is going up as we speak, but we're going to keep a close eye on that. So when we kind of package it up and summarize, the big question I have for people, and I want to answer for you, is does the breakthrough of these new market highs carry any meaning going forward? And I think the true story is not really. When you look at history, statistics show that when a market reaches its peak, it has maybe about 3% more to go before, on average, about a 10% correction. And really, we need to see a permanent and sustained growth, not that kind of funny money growth that we're seeing as a result of the $85 billion on a monthly basis. Fourth page, we wanted to focus on what will happen when interest rates rise. And again, they're trying to go up right now, but the government's holding them down. So they will eventually, and we believe there's going to be that paradigm shift that you're going to have to understand that as interest rates go up, government bonds go directly down. There is no credit-related aspect. So every 1% increase in interest rates, the 10-year government Treasury will go down about 6% in value. Stocks go up, however, and if you look at that fourth page, it's interesting to see how much stocks go up when interest rates go up. So the allocation to win would be with more stocks. The past 30 years, you could have 20% of your money in stocks and 80% in bonds and outperform the stock market. You're not going to be able to do that going forward. So as you mature and grow closer to retirement, bonds really aren't going to be are not going to be as big a part of your portfolio, or shouldn't be as big a part of your portfolio as they have in the past. So times have changed, and so does the thought process and asset allocation. I want to thank everybody for their continued trust in the All-Star team. Remember, our referral program can reduce your fee as we go forward. It's been a great program, and we really appreciate everybody participating in that because that's how we grow. And again, contact information. But again, thank you very much. We appreciate your business tremendously, and we hope you have a great day.